This is Vishwas M, digital marketing expert from RERA Consultants LLP. I welcome you all for today's webinar on GST series for real estate. Today's topic is computation of GST liability for builders and landowner in revenue sharing arrangements. I am honored to welcome our speakers for the day, CA Vinod sir, CA Rajesh sir. Let me start by introducing our first speaker for the day, CA Venugopal sir. He is a founder partner in Venu and Vinay Chartered Accounts since 2002 with academic credentials, which include securing all India 45th rank in CA finals. He is also certified information system auditor. He has completed various other certification courses from ICI, namely DISA, course on business valuation, course on internal audit, course on fraud detections, forensic accounting. He has also completed a one-year course from IIM on data analysis and business intelligence. He has authored various industry-specific and books on GST. He has contributed to the technical guide on GST audit released by ICI other publications materials. He conducted workshops on filing returns with easy use of automation. He has developed a lot of Excel-based free utilities on GSTs like JSON Reader, creating JSON files, GST invalidator, composition versus regular benefit analysis, GST impact reader, real estate project switch decision analysis, GST audit working paper tool, and many more. He is a GST faculty for ICAI and conducted various workshops and webinars. Apart from audits, he has hands-on coding in Visual Basics, .NET, Python. He also reviews database designs. He conducted various workshops for corporates on use of technology, improve efficiency at work using Excel, building automated reports from accounting and financial applications. He is the man behind the development and managing of cloud applications like TaxSmile, Insta Financials, and others. Now, it's the time to introduce our second speaker for the day, CA Rajesh sir, who is one of the top chartered accounts in practice and partner at Venu and Vinay Chartered Accounts and proprietor of RKTR. And he is practicing in the field of indirect taxes at Bengaluru for more than 20 years and advising clients and compliances, tax planning, and representation to the government and authority. He has authored a number of books on GST, central excise, service tax, KVAT as author, joint author, as well as assisting author. To name some of the books, handbook on annual returns and GST audit, GST reckoner, GST tariff, practical guide to service tax, central exercise made simple, central excise law and procedures, and KVAT audit manual. He has also contributed for background material on GST and UAE VAT published by ICAI. He has been training the professionals, students, industries, and department authorities in the field of indirect taxes on invitations from ICI, ICSI, NACIN, tax department, and state and central, educational institution, trade bodies, professional bodies, and many more. He has written many more articles on central excise, service tax, VAT, and GST for various professionals and professional journals. Today, from these experts, let us learn more about taxation of construction service, taxation of unsold inventory, taxation of units sold before occupancy certificate. Now, I request Venu sir to take over from here.
Okay, so firstly, a special thanks to RERA Consultants LLP and association with Naredco. They're doing this GST series for real estate every month, and Opaza, the partner, sponsoring partner for the event. And thanks to all of you for being here and making the session interactive. This session is extension to the previous week session. In the previous week, we had a discussion on builder's liability, landowner's liability in the area sharing. And we have seen practically how it works. We have taken in Excel different numbers. Today's session is extension of it, and we are going to see revenue sharing. So in the revenue sharing projects, it's mostly the landowner is unwilling to take the ownership of the units belonging to his share, and he is not willing to take the responsibility of the marketing and everything. So he is leaving the whole of these aspects to the builder itself to continue do the whole activity. What we are going to see, if it is a revenue sharing model, what would be the levy on the developer, and is there any applicability of development right, RCM, and anything on the landowner? We're going to see, and more focus, we'll be having a practical illustration with the examples. And like the last time, we will do a lot of iterations and see how the numbers are coming. Today, we will also see between the previous area sharing that we have done, we had some numbers. So we will practically see if someone switches from area sharing to the revenue sharing, will there be any change in the taxation? We will be seeing that also. Okay. Now, just a quick recap. In the last session, when we had an area sharing, we clearly said the first supply is the landowner giving a supply called development right to the developer. By virtue of this supply, the developer is giving back to the landowner a supply called construction services. Now, with this construction services which landowner is receiving, this landowner is making a further supply called supply C to the end customers, which is sale of apartment and UDS. What was given was a development right, what he got was apartment. And the units akin to the developer, we have seen the supply D, where the landowner, developer is further selling to their customers. This is what we have seen in the last week. Now, this vis-a-vis the revenue share, what is the change that happens? In case of revenue share, the revenue share, it is also clear that the landowner is making a supply called development rights to the developer. So supply 1 exists. In lieu of this, the supply B, which was a construction services, is no longer given, and the landowner is getting a share of revenue. And by virtue of this, what we saw, the supply C, the sale to end customer, even this no longer exists in a revenue sharing, because the landowner is getting all the share of the revenue that are units which are being sold. So there is no longer supply C in the revenue share, while the supply D, which is sale to end customer by the developer, exists. If you look at it, the change, there was a construction services for supply B, and supply C, the end user supplies were there. Both these supplies doesn't exist when it comes to revenue share. So primarily, the first change that has happened is the developer is no longer providing a construction services to the landowner. Given that the landowner is not getting any construction services, he will not do any further supply of units to the end customer. So two supplies are got disconnected between the revenue share and area share. So a quick comparison in the area share. So landowner gave the development right, and developer submitted back it by way of construction services, which the supply C undertook the landowner selling to the end customer. While in the area share to revenue share, we have seen this construction services has gone up by developer. So it is only share of revenue out of some money that is getting a revenue is shared. Now let's start looking at the taxation of each of the elements individually. First and foremost, the taxation of the development rate. This doesn't change. Same like the earlier last taxation. Even here, there is taxation. The landowner has supplied the development rate. We cannot say the landowner has not supplied the development rate. And the HSN 9972 18%. Now the question comes is, what is the value? So here the value of the taxation is whatever is the monetary value of the share that has been given by the builder to the landowner, the units sold till the date of OC. However, on the date of OC, there is some inventory which is unsold, which is left. And mute others, please. Yeah. So the monetary value of the units that have been sold before OC, the landowner will be getting 30%, 40%. What is the agreed revenue? That is one value. The second value is there is some units which is remained unsold on the date of OC. What happens to that? Now, generally, landowners would continue this joint venture. I will say as a joint venture because landowner want to be part of it. So this is a general practice. There will not be, for the unsold units, there will not be any allocation of the unsold units. Generally, that doesn't happen. So of course, anything can happen. Business, anything happen, but generally, the unsold units are also continue to be sold by the developer and builder, because every builder wants to liquidate their inventory at the earliest and move on. So even the unsold inventory will continue till they are sold, and the marriage between the landowner and developer will continue, and the revenue is shared. But for the purpose of the taxation, we go to freeze out. Notification 6/2019 gives that to tax this, and we have to do a valuation of the units that are left. So a share that the landowner is going to get, which is akin to him on the OC date for the unsold unit, is also added, which again we will see in the example. Is there any exemption? Of course, there is an exemption which is given. There's an exemption by way of 41/2017. Of course, this is a conditional exemption, which we have clearly seen in the last week how this exemption works. Just to give you that how it works, they're given the valuation of the apartments which are unsold on the OC date, whichever is the value at it, which we have seen the definitions, and the exemption in the hands of the developer, because it is a reverse charge. It is the exemption in the hand of the developer. It is whatever is the GST liability on the TDR is allocated in the ratio of residential to the carpet area of the total. So unsold residential to the total carpet area is what considered for the exemption. This portion will be exempted provided it is a conditional exemption subject to a condition. So the condition given here is the value developer has to pay a certain value under reverse charge basis. So if the developer is paying a certain value under reverse charge basis, the primary exemption of development right taxation has been given up. So there was a computation of the taxation of GST on TDR payable. This we just now saw. Whatever is the development rate value at the 18% is the value of the TDR. And this value gets taxed in two different forms. This value gets taxed in two different forms. The form one, the first form is whatever is the GST which we have computed is allocated in the ratio of unbooked as on the date of OC divided by the total carpet area. Even this we have detailed seen in the last week. And the second option is whatever is the market value or the open market value, the last sold unit value at applicable rate, 5% or 1%, whichever is lower. It is minimum of either of these two is the minimum value the developer has to pay under reverse charge. This is the minimum value the developer has to pay under reverse charge. This is what we have seen. Now, this continues the same in the revenue share. In the revenue share also this continues. There is no change in it. By the way, both Rajesh and Ashika are in the department. So once Rajesh sir may join any moment, he would add his views as he joins. Vishwas, when Rajesh sir joins, please make him as co-host so that he can take up the point. So if you have any questions, please put your questions in the chat. All right. So this is the first aspect of the taxation, which is supply of development rights by the landowner to the developer. Now let's look at the supply B, which is the revenue share to the landlord. In the revenue sharing transaction, as I clearly said, supply B, it's actually not a supply. It is only a transaction. This is not a supply, it's only a transaction since it is a share of revenue. So now we will look at the second leg of the transaction, which is money that is been shared by the developer to the landowner. So compared to the area sharing, this being a revenue which has been shared. In an area sharing, when an area is given, that was a construction services. If you remember in the last session, we have clearly identified this transaction as a construction services provided by the builder to the landowner. While in a revenue share, this is a transaction in money. So the money which has come to the landowner, money which has come to the developer, he is paying full tax on that, and a portion of it is appropriated to the landowner, which is like how a partner in a partnership firm shares the share of the profit which is left. So even this transaction is akin to it. It is a transaction in money. Here there is no supply provided by the developer to the landowner. It is only a transaction in money. So the landowner is selling the development right and he is getting the money. That's all. So landowner is selling the development right and developer is buying it by way of revenue share. That's how you can treat it. So since it is money that is received by the landowner, which is a tax paid thing, it's an appropriation of revenue. There will not be a second limb taxation, which was there in area sharing. Now you may say that, okay, if that being the case, wouldn't it from the tax perspective, the area sharing would be better? The government, revenue sharing would be better. The government would be getting a lower tax and it is beneficial, but the answer would be no. We will again see with the example, both would yield the same thing. Moving on to the supply. I'll try completing this in another 5-10 minutes and we'll spend more time in Excel looking at the practical aspect. Supply C, which is in an area share, the landowner used to sell to the end customer. But in revenue share, this doesn't even apply. So this next set of leg of transaction will not be there. So if you see supply C, the landowner to the end customer is the money received by the supplier, it is stopping there. So we cannot say the taxation of supply C. Unlike in area share, which you are seeing on the left side, where the landowner is selling his share of apartments and units to the end customer, where the landowner is again liable to pay 5% GST on the full sale value, but he is getting input tax credit. That's what we have seen last time. But on the right side, if you see in the revenue share model, landowner has nothing to do with supply C. It is not at all applicable. So there is no supply C, no levy of GST, even this goes up. So in terms of the taxation, the revenue sharing, the taxation is pretty simple, very simple. Compared to the area sharing, the revenue sharing transactions are simple because most of the elements are out from the levy of the taxation perspective. All right. Now let's move to the last element, which is supply D, which is sale to end customers by the builder. This is same both in area sharing and revenue sharing. The taxation is same. Whenever the units are sold to the end customer by the developer. So this is the last leg of supply. So the developer is selling to the end customer. Now the developer is liable to pay the taxation at appropriate rate. So firstly, ITC cannot be availed. So developer has to pay 5% on the total sale value. It is actually 7.5% to 2/3. 1/3 is the land deduction. So eventually, effectively, it is there as 5%. And the developer cannot use input tax credit while for discharge of this liability, he has to pay it in cash. You may ask this question, if the developer has not even availing ITC, where is this question of paying it through ITC? Now, developer might have business one, business two, business three. There are multiple businesses. Now, in this business, he is not using the any ITC, but he has another business where ITC is available. So, Section 49 permits him to discharge the tax liability using the input tax credit. You may ask that, okay, I am paying the taxes. The answer is no. One other condition is this tax has to be paid only through cash, definitely not using the input tax credit. This is the fourth limb of the taxation. Before I get into the practical aspect, so do you have any questions? If you have any questions, you can put it in the chat. Else, I'll spend in the Excel, we will actually see how this works. Any questions to anyone so far? You can put your questions in the chat. All right. So let me take you through Excel. Hope my Excel is visible to everyone. If my Excel screen is visible, please put it as yes in the chat box so that I know that it's visible. Is the Excel screen visible to everyone?
Yes, sir, it is visible.
All right. Okay. So again, the facts of the case, we kept it same. I'll repeat it for the thing. Assuming in an apartment where there are 100 units, area per each apartment, let's say 1000 SFT, and on the date of JD, joint development, we have assumed units are sold at the rate of 10,000 per square feet. That means each unit would have got sold for 1 crore. Each unit would have sold for 1 crore. And the rate per SFT on the OC date, generally there would be a premium of 25%. I've just kept 10%, so I'm making it at 11,000. All right. Which means the value of unit, if it is sold on the OC date, it is 1.1 crore. The sales are happening evenly at a different point in time. So I am making average sales at 1 crore 5 lakh. Each unit got sold for our ease of calculating and understanding. Okay. The landowner has 40% of the share. So revenue share 40%. All right. So this is the taxation for revenue share. So 40% is the landowner. So every rupee builder is getting, he is giving 40 paise to the landowner. Builder is keeping 60 with him. We have also assumed another fact. As on the OC date, 85% of the inventory is sold, 15% of the inventory is left unsold. Just to sum up the valuations of it, that means as on OC date, I have sold 85 apartments. 85 apartments means 85 crores. Since it is average sold at 10,500, it is coming to 89.25 crores is the sales value. This is allocated in the ratio of 60% to the builder, 40% to the landowner. So the revenue has been shared between both of them in this ratio. Now, as on the OC date, 15 units are remained unsold. 15 units are there which are unsold. And on the OC date, we said the market value is 1.1 crore. That means the value of this 15 units will be 16.5 crores. So 16.5 crores. Now, these are not sold. Revenue is not given to the landlord yet. Revenue is not given to the landlord yet. However, we are making an assumption that if these are sold as is basis, since the project is getting completed on this date and we have to determine the taxation at the open market value, the monetary value of the units that are akin to the landlord and the builder will be 6.6 crores and 9.9 crores. Now, base is this. Let us understand value of the taxation of the development. Basically, let's understand the development right taxation. So if we have to understand the development right taxation, let's first look at the value of the units that have been given to the landlord. Value of the units that have been given to the landlord. So to the landlord, 35,70,000 has been received in cash. 35.7 crores has been received in cash for the units sold. Value akin to units unsold is 6.6 crores. So the total value which landlord got is 42.3 crores. So if you can see here, the value given in the barter to the landlord is 42.3, which means if the project as is basis, if all units have been sold, 42.3 crores is what landlord would have received. Now, if there is any non-refundable goodwill, if it is given, even this would akin to the value of the development right. So the development right value here is 42 crore 30 lakhs. Development right in this transaction is 42 crore 30 lakhs. And please don't go by the income tax logic or the accounting logic that the landowner has given the land, everything. So each act has its own taxation. Now for this 42 crore 30 lakhs, the GST on the development right is 18%, 7 crore 61 lakhs. And this being an RREP project, there is a 100% exemption in the hands of the landowner. 7 crore 61 is exempt. So that is what we have looked at the example. Let me just take you back here. The PPT. So in the development right, we have said the value of the development right would be the monetary value of the units given and the value of the unsold. And this is exempt. So in the current case, the GST payable on the TDR in the ratio of residential and commercial. So here 100% residential, so 100% is exempt, provided the developer pays under RCM. What is under RCM? There are two conditions that we have seen. One, carpet area of unbooked units to the carpet area of the residential. So if you go back here, now as on the date of OC, what is the total carpet area in the project? We said 100 units, 1000 SFT per each, so it is 100,000 units. So 1 lakh is the total carpet area. And the carpet area of the unsold units. So 15% has been left unsold in the hands of the builder. So the builder has, we have given an assumption here that the builder could only sell 85%, 15% he did not sell. So which means 15% of 1 lakh is 15,000 is unsold. So there are two taxations here. One, first taxation is this entire 7 crore 61 is allocated in the ratio of unsold. So that comes to option 1 crore 14 lakhs. It comes to as option 1 crore 14 lakhs. The taxation 2, the GST on unsold units at the rate of 5%. Since these are 1 crore, so these are not, this will fall in other than affordable housing. This is not affordable housing. So 82 lakh 50,000. Now this taxation actually changes, like as I said, on the OC date. On the OC date, the value will be 25-30% up. Then when this goes up, then like if instead of this value of unsold units, instead of this value, if I have taken it as 1.2, my 1.25, like you can see it is 1 crore, right? So this value goes up automatically. So whichever is the minimum is what the builder has to pay. Now let's just keep it as such. So from the taxation of the development right perspective, he would be paying lower of 1 and 2, 82 lakh 50,000 he'll be paying. Supply to, which is construction services otherwise provided by the builder to the landowner, this being a revenue share, there is no concept of supply to, there is no construction services, no GST is applicable. Supply 3, sale to end customer by landowner, which we have seen under area sharing, even this is not applicable. Supply 4, which is sale to end customer by the builder. Sale to end customer by the builder. So in the current example, we have seen 85%. So 85 units are sold. So the value of the units sold, we have seen it is 89 crore 25 lakhs. So this is the value of the unit sold, 89 crore 25 lakhs. So 5% on 89.25 crores is 4.46. So if you see in nutshell, the GST that is payable in the area sharing, in the revenue sharing basis is one RCM on the development right 82 lakh 50,000 and sale by to the end customer 4 crore 46. Total 5 crore 28 lakhs is what the revenue which the government will be getting. Now, let's look at this in the area sharing. The other day we had the example, same example as area sharing. Let me just open the Excel of area sharing. Now let's look at the area sharing itself. You should differentiate. Let me just put this as area sharing. And okay, revenue sharing, I made it into blue color. So in the revenue sharing, we just saw 100 units, 40% to landowner, sold before OC is 85%. Government is getting a revenue of 5 crore 28 lakhs. Now let's go to area sharing. Let's also put the same thing. So landowner is getting 40%, sold before OC is 85%. So you can see here, how much is the government getting? So this is what we have seen a detailed working last time. Here there are multiple. So here RCM is different. So there is a construction services tax, sale to end customer.
No, the other screen we are not able to see.
Sir, can you see the area sharing?
Now we are able to see.
So in this example, we have just, this is what we did last time. In the last time when we saw the example, it was clear that 40% was to the landowner and 85% were sold as on the date of OC, 15% were remaining. Here we did, since it was a detailed where the development right was there to the landowner to the builder, construction services was given by builder to the landowner. These units were further sold by the landowner to the end customers. He has also availed ITC and reversed some ITC, and the landowner sold his units. So in this scenario, if you look at it, by reversing ITC, by paying all the cash, what government has earned in this transaction is 5 crore 25 lakh 75,000. While in this revenue share, you can see 5 crore 28, which means whether you do area sharing, whether you do revenue sharing, if the numbers are like comparison same to same, the taxation remains the same. There is no tax arbitrage between revenue share or an area share. Of course, it all depends on the intention of the landlord, whether he wants to retain some units. his trust on the developer, his ability to developer's ability to sell, because sometimes the premium the developer can command, which otherwise the landowner cannot command. Next, the timeliness in which the unit that gets sold, all these matters, right? Hence, the decision to do area share versus revenue shares can never be basis the GST taxation. It is purely basis the commercial ability between the landowner and the developer. Just to put a simple point, in the revenue share, what we have seen in all of the transactions, what we have seen is the development rights are sold to the developer, and in lieu of it, the developer is paying consideration to the landowner in the name of revenue. So the developer is giving a portion of the revenue, landowner is selling the development right. By virtue of it, the developer is building the apartments and selling to the end customer. Landowner to end customer, the concept doesn't exist. Broadly, this is how the taxation works. I think we have seen the practical workings of the Excel also, both the revenue share and the area share. Now we will look at the questions that we have, but before the questions, I would request Rajesh sir to add, he's joined with us. So Rajesh sir to add his views.
Venu,
Yes,
I
sir.
think before the thing starts, can you just go back to that screen which you are showing just now, that summary of the chart, the PPF, sorry, PDF. Yes, yes, yes. The assumption here is only the developer is a supplier and landowner is not a supplier
Correct.
in a revenue sharing. But if the documentation are affected in the name of a landowner to the ultimate buyer, and developer merely pitches in as a GPA holder of the landowner, will the scenario be same?
This definitely a caution to everyone, is the taxation always goes by the way it is documented. Now, if someone pitches in as a builder, he says that I will do an area share, revenue share, everything, but on paper, he is acting as a works contractor. He holds some GPA, but whether it comes to RERA or all other aspects, the builder is not the, firstly, there is no joint development agreement which is registered. So we also have to give, though substance is a joint development agreement, but the form is not the joint development agreement. The taxation will not be as joint development agreement. The taxation will be like a works contract services, where the builder is providing a works contract services, but he is acting as an agent to sell the units on behalf of them, on the landowner, everything. So though the substance is the same, since the form is different, the taxation would change. So definitely one has to pay attention to the documents which both the parties are signing to. The taxation would change. That would be the answer.
Okay. Got it, Venu. Because there have been advanced ruling, in these cases wherein they say the developer is liable to pay tax only to the extent of whatever the share he is going to get, and not on the entire consideration. So that being a case, what happens to the balance thing? So I'll put across a little differently. Here, the developer, it is not that the way it is presented, it is actually there will not be supply D, instead there will be a supply C. In other words, all the sales are affected effectively by landowner in real sense, though in a joint development, and all the consideration is received in the name of a landowner, but a certain portion is received as a revenue share by the developer. That means 100 rupees or 100 crore is received in the name of a landowner for executing a sale deed or agreement to sell whatever it is. Out of that 100 crore, 40 crore or 45 crores, depending upon the period in when it is sold, will be received or retained by the developer. Balance 65 is paid or is going for a landowner. So effectively in such a scenario, my question is, who has to pay tax to the government? Here in the model which you explained, the developer is well and safe. But will there be a liability on a landowner also, thinking that he has not at all paid even 1 rupee tax in this entire transaction for the sales affected to the ultimate customer?
Sir,
This is what the question.
yeah, as is basis, there is no levy to the landowner because he is only selling his development right and collecting his money. He there ends his role. But if the landowner is the one on record doing these services to the end customer, then similar to the area sharing basis, the developer will have to charge for the works contract. And while landowner will not get any input tax credit in that scenario, he would end up paying the GST on the full values. Maybe it might not be a viable decision to do that kind of structuring for GST.
Why do you say that the landowner will not get ITC of whatever charged by the developer?
Because
At the 5%?
he will be a builder since he is at a 5%.
He's still a developer and a RERA. Area
So
developer.
yeah, on record, you are saying that he would be a developer, is it?
There will be a joint on records. Both will be called as a co-developers.
If it is on record, both will be there as a joint development. So it is more like an area share. So everything is area share, and the landowner will have to pay GST by taking ITC.
Got it. Okay.
Yeah.
I think this is exactly what I wanted the participants to understand.
Correct.
In this revenue share, there is no one methodology which is possible. There are multiple ways. This revenue sharing is all dependent upon whether really it's a JDA. Is it merely a service of contract of a service for service, or it's merely the same thing like a area sharing? It's only a matter that instead of the physical area, money is being flowed, so all tax treatment goes with that. Is a lot of confusion do exist. So one, please look at the documentation, the paper, and the RERA documentation has to, whether both are joined, co-developers mentioned over there are covered within that ambit, and accordingly have to act. And whether there is a final output and eligibility of credit under 5% or 18%, all these questions will be there. I think when you can just summarize in the context which I'm trying to say.
Yes, sir. I'll take the questions, if any, and finally, before we wind up, I will do one summary between area share and revenue share.
Venu sir, can I have a question, please?
Yes, sir.
Venu sir, this is in regard to the area sharing, right?
Yeah.
And I am linking it to RERA. So a practical question which comes up is, even when I am selling my apartment, I'm a registered RERA project selling an apartment. The landowner is selling his apartment under area sharing, right? So his money should logically come into the RERA account, 70% account.
Sir, honestly, I will park this question. I would expect RERA team to answer, because it would not be right to comment other than GST. So a request to.
I have a question on GST only.
So the money is parked, even the landowner's money is also parked into that pool account. 70/30 is applicable.
And a GST is payable by the landowner, and the money is parked in the pool account.
Absolutely. GST, landowner has to pay GST at the rate of 5% on the full sale value, which is sold to the end customer by the landowner.
Okay. And there is no issue if the money is parked in the RERA. So GST department does not have an issue with this.
They do not have issue. Just that the landowner will get a concept of input tax credit kicks into the landowner.
Okay, thank you.
Yeah, sir, I have one query. Can I answer? Can I ask?
Yes, Ankita madam.
Sir, I have posted it in the chat box.
Huh.
How to value TDR in case of revenue sharing commercial projects,
Yeah,
as we do not know the exact revenue at inception.
right. So, madam, even here, if you see in the valuation which I have explained, whether it is commercial or residential projects, when it comes to the revenue sharing, we are looking at the revenue at two aspects. Firstly, the development rate taxation owing to 6/2019 is on the OC date. For the units which have been sold till the OC date, actual realization that has happened akin to the landowner, his share. For the units which are remained unsold, which will be sold at a later date by the developer and the revenue that would be shared, is the open market value of the units which are akin is what we are taking. That's how we compute. In fact, in the Excel, if I to switch back to the Excel, you can see in the Excel, we have seen that the 40% goes to the landowner, like 40 units, 40 crores goes to the landowner. So 35 units have been valued at the rate of average 10,500. Balance 15% units have been sold. You can see it is valued at the rate of 11,000 because that's the value which is there on the OC date. So eventually it is becoming 42.3 crores, while the 40% 40 crores, 42.3 crores. That is how the valuation would be applicable.
Commercial projects also, because in case of commercial projects, we have to pay GST on the date of like JDA itself for development rights.
Madam, the development right, because you talking about a pure commercial?
Yes, pure commercial project.
Okay, madam, pure commercial, the commercials work in a different way. In fact, what we have taken up is only residential. The next series is only on commercial. So we will take up commercial because in the exemption is applicable only in a RCM projects, like what we have seen the exemption which I have given here. You can see the quantum of exemption is linked only to residential apartment and not to the commercial apartment. So we will see at the full-fledged session for the commercial.
Okay, sir. Thank you.
Any other questions?
Excuse me, sir.
Yes, sir.
Sir, some Praveen sir is have asked some questions in the chat box, as well as another Srinath sir. Both of them have asked the questions in the chat box, sir.
It is not showing up to me. I don't know whether they have sent personally to you. Maybe if you can read out the question, it would be easy for me.
Yes, sir. Praveen sir. Praveen sir.
Yes, sir.
You can ask the question, whatever the doubt you are having, sir.
Sir, good evening, sir.
Good evening.
Sir, basically in a revenue sharing agreement, actually, who is it? Who is the person who's actually selling the flats to the buyer, sir? Is it the landlord who is selling the flat to the buyer, or is it the developer who is selling the flat to the buyer?
It's clear on the screen. So it is the developer who is selling flats to the buyer.
Okay, so because basically now, see if the land belongs to the landlord and he has appointed the developer to develop the project, and this project would be sold and the developer would be retaining a portion of it and the landlord would be sharing a portion of the revenue.
Correct.
So can it be viewed that it is the landlord who's actually selling these flats to the buyers and developer is providing only construction services to the landlord?
Yeah, you are bringing a good point, a different dimension. So the participants, so what the view which is coming here is the developer it is not the landlord getting 40%. It is the developer getting the 60%. And the landlord is the one who is selling whole of the units to the end customer. But Praveen sir, if you see the practically the documentation that happen and the sign, landlord will not be into the picture. Why landlords choose the revenue sharing models is, I don't want to be in the picture. I want the builder to handle all the sales transaction and everything, right? But if you swap, assuming for a moment we swap it, saying that the developer has built 100 units to the landlord, and landlord is now selling that and sharing the revenue, then why would it at all be a joint development agreement? It will be a straight works contract construction services, no?
Yeah, that was my second query, sir. Like, how do we distinguish between a JDA and a works contract service? How do we distinguish between that?
That's the documentation.
Okay. Now, because for all documentation, sir, it will be the landlord who is going to transfer the UDS. It will be the developer who is going to provide the construction
The
services.
area share or revenue share, sir, by virtue of the joint development agreement, the developer has acquired the right in the UDS. But the moment the plan sanction is done, they will do the sharing arrangement. And in an area, in a revenue sharing, they will do saying that the developer is going to sell all these units.
Okay, sir.
Yeah.
Fine, sir.
So any other questions before we conclude?
Sir, excuse me, sir.
Yeah.
Anand BC, Mr. Anand BC
Ah.
is asking a question. Sir, Anand sir, if you are, you can unmute and you can ask the question, sir. Anand sir? Yes, sir. He is asking a question as GST on the construction service forced by 1/3 of land deduction is ultra virus GUJ HC decision.
Gujarat High Court decision, okay. Manish Munjal by decision, okay. Sir, Anand sir, I would still say that decision, since it is pending with the Supreme Court, we cannot consider that the decision has attained the finality. And my personal view is firstly from the RERA perspective, you got to have a single agreement. Having a separate agreement for sale of land and sale of constructions is not permitted. And this notification has been given under 15.5. So doing a 1/3 forced 1/3 deduction is right and not going at two different values. However, it is subject to litigation. So the risk appetite of both the developer and the landlord to take that view, but safest view is to go with 1/3.
Okay, thank you, sir. And another question from Mr. Srinath K. On area sharing, landowner villa GST payable is first villa value or last villa sale after OC.
Can you repeat the question?
Once again, I will repeat the question, sir. On area sharing, landowner villa GST payable in first villa value or last villa sale after OC. Means
Sir, when the landowner share is being sold, whatever is the value at which he is selling, he will be paying GST. So I don't know, this concept of first or last will not come. The concept of first or last will come for the valuation of the development right, and the valuation of doing the construction services. And that is where we are looking at the value as on the JD date and this. But when it is sold to the end customer, whatever is the actual value, that is what to be adopted.
Hello.
Yeah.
Yeah. So can I ask one more question, sir?
Yes, please.
Yeah. So for the unsold inventory which is remaining, let us assume if it is not getting sold, and if they are captively consumed by, let's say, a few units by the landlord himself and few units by the developer, what would happen in that case, sir?
In a revenue sharing, right?
Yes, sir.
Yeah. So this is what we have distinguished. If you see in the example, but the units which have not been sold, which would be sold at a later date at any value.
No, I'm saying it is not sold at all, sir. Few units landlord registers in his own name.
Absolutely, no problem. It's like whether sold, will not get sold at a different value, absolutely nothing. The value continues to be value as on the OC date. So we have taken the value of this 15 units multiplied by 1.1 crore is 16.5 crores. That is the value which has been allocated. So we are only trying to derive the value in the hands of the developer and the landowner. What they are going to do next is left to them.
Okay, fine, sir.
Sir, Babita ma'am. Yeah, ma'am, you can ask the question, ma'am. Hello. Hello? Hello? Yes, sir. Yes, sir. Yes, sir. Okay, thanks.
All right, so we have come to end of the session. Let me just quickly do a recap of both the transactions. So in an area sharing, the landowner is supplying the development right, which is the supply A. So the value of the development right is the value of the units the landowner is getting in the the value as on the date of JD. Whatever is the value that he is getting will be treated, plus whatever is the non-monetary and monetary consideration which is given is the value of the development right. Now, in lieu of this development right, developer is giving constructed units back to the landowner. So there is a construction services. So he would be again paying construction services tax. Then this is not cost plus 10% or whatever be the method. Whatever is the open market value of these units as on the JD date is to be treated. Of course, both these taxations are paid on the OC date. While these are given to the landowner is eligible for input tax credit. So these units, when he is selling to the end customer, the landowner will be collecting 5% from the customer and paying GST on it. If some units remained unsold using the Rule 42, the landowner has to reverse the ITC on the unsold units. For the units with the developer is going to pay GST whatever which is sold on or before at the rate of 5% which is sold before OC. For the unsold units, the development right taxation kicks in, which will be saying that least lower of the proportion of unsold units or 5% of it has to be paid tax. That comes as an area share. While it is in the revenue share, we have clearly seen the revenue share landowner has given off the development right and the developer has shared a revenue for in lieu of the development right where for selling the end units. So the taxation in the hands of landowner rests completely. As a question Praveen asked, can it be treated as if the developer has fully given to the landowner and landowner sold to the end customer? This is same like a works contract transaction and not a joint development taxation. So with this, we have come to conclusion of the real estate taxation, both area sharing, revenue sharing, RREP projects with a practical Excel.
May I ask you a question?
Yes.
Sir, if there is a plotted development project and their arrangement is of revenue sharing, तो वैसे केसेस में डेवलपमेंट राइट्स का वैल्यूएशन कैसे होगा, बिकॉज उसमें तो पहले फिक्स नहीं होता अमाउंट.
Okay, so sir, on a plotted development, we had a session earlier in detail, and because it is sale of land and we have circular 177 where there is no taxation on the sale of plots. There is the concept of development right would be a little different between the development in the apartment construction and the plotted development. Of course, different authors have different views. Some of them view that concept of 5% would be applicable in the plotted development. But my personal view, the plotted development is akin to a kind of a works contract where the developer comes in and pitches to developing the whole of the layout. The right to develop on that land further still continues. So all those plots have retained the original development of it. So that taxation is completely different the way which we are seeing here. Maybe Vishwas you can connect with the Vishwas and the team. They would share you the link of the plotted development session.
Okay, thank you so much, sir. Thank you.
Definitely, sir.
Hello.
Yes, sir.
Sir, actually, what my doubt is, after OC, unsold villas, landowner unsold villas, which rate we need to pay on GST?
Sir, you are talking about an area share.
Area selling.
Sir, the unsold villas which is remaining with the landlord would be reversing input tax credit. That's all.
It's what rate, sir?
No, whatever the ITC which the landlord is getting.
No, we not taken any ITC. We actually given for 5%.
No, sir. The landlord will be getting an ITC. That is what we have spoken all this while. While the construction services are given by the developer to the landlord can avail ITC. That ITC would be lapsed in case if those units are not sold by the landlord. That's all. Yeah. All right, so we thank everyone for your participation. We also have a GST updates group, so you can join the WhatsApp of community of our GST updates. In case if you still have any questions unresolved, you can reach to me. If it is more technical and any litigation points, definitely you can speak to Rajesh sir. He practices on the appeals and other high court matters, especially in the real estate sector. So you can always reach to us for any further clarification.
Venu sir, related TDS, we need to one section for that. Actually, we need to understand that. See, landlord share, developer is selling the villas, okay? The
First,
customer
I
is
want you to tell me whether area share or revenue share.
area share, okay?
Ah,
Area share developer, landlord is given to sell the developer to villa. That amount it will come to developer only, okay?
no,
While
if the
share,
landlord is selling, why will the amount come to developer, sir?
no sir, it has to come RERA. No, the developer
It
landlord
is
is
coming to
given
the
to.
RERA account, RERA pool account.
See
Okay.
that I understand, sir. Okay, that landlord is given permission to sell the developer based on documentation. Hello. Based on documentation, builder developer is sharing the villa, landlord villa. That amount is receiving to RERA. At the time of sale consideration, that 1% TDS is deducting and is paying to developer only.
No, when the developer units are sold, the 1% TDS goes to developer. When the landlord units are sold, the 1% TDS should be going to the landlord, right?
But that amount is coming to RERA now. We have to give back to landlord. How good that TDS is work out? That we need to understand.
No. From the distributing of the money from the pool account has got nothing to do with the taxation. No, it's a transaction in money versus principal to principal transaction.
Okay, and TDS base how we will TDS
Again,
also the PAN number.
income tax question, definitely I am not the right person, though I have an answer, but I am not an authority to answer it. Maybe we will request Vishwas and team to host one specific session on the TDS and income tax also.
Okay, only TDS related, sir. Income tax is okay. TDS we need.
No problem. Please write to them, sir.
Okay.
Venu sir,
Yeah.
I have one query, sir.
Yeah.
Sir, in one scenario, I just want to understand. In the land, builders has purchased the land from the landlord, and 50% has been paid in the cash, settled in cash, and balance he has shared the area. I mean, he has area given back. It's a barter transactions. In this case, is again construction services applicable here?
So here now, given that the builder himself is a landlord, so he is only now providing the construction services to the 50% of area. So for the 50% of the area, if let's say if 30% is been agreed as area sharing, so out of 100 apartments which are getting constructed, only 15 apartments will go to the landlord. So there is an area sharing. So there is a taxation kicks in only to the extent of the units that are given to the landlord.
Okay, and whether this also considered as JDA or it's a outright sale, looks like.
It is, since you still have a portion of the land with the landlord, it is still a JDA, sir.
And
Only when you build everything on your own land, it is not a JDA. Even some portion of land is the landowner and there is a developer, it would become a joint development agreement.
Okay, sir. Okay, sir.
Sir, one more question is that while availing ITC by landlord, is it the rate of at 5% has to be paid?
Correct. It's a 5% rate has to be paid. Correct.
Okay. Thank you, sir. I think there is any questions from our participants. Okay, sir.
All right.
Yes, sir.
Rajesh sir, any closing remarks?
Yes, I think basically this taxation of revenue share going through the wordings of the notification has possible multiple views.
Correct.
So, though broadly the proposition has been explained in this session, somebody has to carefully look at the wordings of the joint development agreement, the RERA documentation, as well as the further agreement to sell under the sale deed, which they are going to execute. Not merely accounting entries, not merely the accounting of a transactions in the books of accounts or the money flow will not only decide the nature of transaction. Essentially the documentation plays a vital role. So one has to be very careful and take a overall conscious decision as to what should be the tax treatment, who has to pay, and under whose obligation to pay to government is something which you have to be careful about. Especially, I think many of you are up here attending here are developers, and some of you are professionals. For developers, obviously will take care of your interest, but as far as the consultants are concerned, if there's professionals, if the landowner is your client, also look at it from their perspective, how a taxation has to be looked at it from their perspective, and where it is, if some compliance is required additionally to be done, where in totality there cannot be any additional liability, not taking a risky proposition, you may have to look at that aspect of it. Okay. I think with these words, I hand over Venu to conclude. No problem.
That's it. And definitely today we had quite a number of good questions, and I'm sure there is some confusion still on area share, revenue share, and the taxation. I would request you can subscribe to this channel, and there in the playlist you have the earlier sessions. Please take a look at them and feel free to reach to us. And as Rajesh sir rightly said, this area is open to multiple interpretations. So the more it is discussed, good. We never endorse that our view is the final view, and like Munish Manjalbhai Bhatt case, there can be Gujarat judgments type which can come up with a different interpretations. Yeah, please always consult the chartered accountant before you finalize, because each contract wordings are different, and the substance can be the joint development, but if the form, the structure is not joint development, the taxation changes. That is something you should be keeping it in mind. So with this note, thank you, and hand it over back to Vishwas.
Thank you, sir. We will be sharing a recorded link to all the participants once after the webinar get finished. I thank all the speakers for giving us their valuable time and insights on today's topic, and also wish to thank all the participants today for patiently participating in the session, and it was very interactive session. Thank you once again to all. Hope the session was informative and knowledgeable. If you have any queries, please do contact us. Thank you. Have a great evening.
Thank you.